Hey everyone, my name is Michael Pierre and welcome to Mindful Investing. Today's video is going to be one I'm pretty excited about because we're going to be talking about the Fibonacci sequence. And the earliest records we can find of this phenomenon places us back somewhere between 450 and 200 BC when Indian mathematician Pingala completed his work called the Chanda Sastra, I believe. I'm probably butchering that, but loosely translated means knowledge of the science of meter. He's also known as the father of binary numbers. Of course, that's long before computers were around. So it's very interesting that someone was thinking about that, thousands of years before it was really applicable on the level that we have now. But I'll leave a link in the description if you want to know more about that. I just kind of wanted to preface the inventor to our knowledge. Because it was actually brought to Western culture by a man known as Leonardo of Pisa, or Leonardo Fibonacci. That was around the early 1200s, so it was known for at least 1500 years before it was introduced and popularized. But he was the one who, introduced it to the Western world, so of course it was named after him. And I believe it's good to know not only what something is, but to know where it came from and how and why. So I just wanted to give you a little preface first, but we got a lot to cover, as you know, so we're just going to jump right in. So the fundamentals work like this. In a set of numbers beginning with 0 and 1, if you add the last two numbers together, you get the next number, and these are referred to as Fibonacci numbers. So it goes 0 plus 1 is 1, 1 plus 1 is 2, 2 plus 1 is 3, 3 plus 2 is 5, and continuing the sequence you'll get 8, 13, 21, 34, 55, 89, 144, 233, 377, 610, 987, and continuing into infinity. So if you divide each of these two consecutive numbers, like 8 and 13, 21, 34, if you divide those, you'll always arrive at the same quotient that is oscillating around the number 0.618, and this is known as the golden ratio. So if you plot this out geometrically, where each square is a perfect square, and connect the edges to one another, you'll notice perhaps a familiar shape appears, one that shows up in all aspects of nature, on the largest and smallest scales. This sort of spiraling shape that you'll see in many things, like Milky Way, as far out as structures as that, to really anything, seashells. Well, now I'm digressing. But the way I use it when trading is I'll actually use the Fibonacci numbers and in relation to the EMAs that I like to use. So each of my EMAs here are in fact Fibonacci numbers, and when you have actually all the way up to 4,181, so these later ones won't always apply because there might not be enough data in the chart to fulfill 4,000 candles, but on the smaller time frames it works a lot more often. So here on the Chipotle chart, you'll see a kind of a contraction and expansion again of all these moving averages that form sort of a ribbon. So when one thing I noticed is that in uptrends you'll see all of the moving averages below the price and providing upward support, as shown right here. So they'll just continue to expand farther and farther apart, and even during these corrections it will not go down very far past the shorter to midterm averages. So of course right here is more of a correction than normal, so this might signify a macro trend reversal, but of course that doesn't have to be the case. But you'll see during bear trends all of the moving averages end up below the price, and it's pushing down, providing resistance. So a good way to know when the trend is reversing, let's see, like right here, you'll have an uptrend and it's starting to contract here, and when it tries to bounce back out and get support by these moving averages, it gets rejected just above the previous high. So this might not have been a pattern indicator, but you'll start to see this, when this price starts to decline more and more, make lower lows. Right here might have been an indicator that, okay, it's getting pushed down and getting closer and closer to these long-term moving averages, as well as more and more of them are starting to go on top of the price and provide downward pressure. So whenever you start to see the majority of these ribbons come on top of the price and push down, that's when you know a trend reversal is happening. And as well as the RSI is a very good indicator of this. So you'll start to see a macro trend in the RSI. So the top out was actually right here, a very overbought condition, and it went all the way oversold pretty quickly actually. But every time it tried to make a rebound, the RSI did not make a higher high. Of course, it would have been very difficult to do so in this instance. So the RSI is very good in conjunction with these EMAs to try and figure out when this whatever trend is running out of steam. So again, you'll see come down and make a very oversold condition right here, and when it starts to try and come up, make a rebound, all of these EMAs are providing downward pressure, and the only one that's really providing support is this very long-term EMA right here. I think it's the one of the ones in the thousands actually. So even right here, you'll see it makes a lower high, and almost all the time you'll try to see it'll try to come up above, see all of these EMAs. It tries to make a push up above all of them, and when it gets rejected back under, that's when you know like another big downward move is coming. So if this were a true reversal and it was coming up, to make another bullish run, you would see it. You would see this, but you would also see this red line providing support and not getting rejected. So the second it gets rejected back down, you know that this type of movement is incoming. Especially again, you'll see this RSI makes such an obvious bear trend long before the price starts to correct. So the higher high again right here was actually at this point when it hadn't even pushed up above, and it was just making progressively lower highs and lower lows for, let's see, April all the way to May. So a good month of downward momentum on the RSI before this price actually started to correct. So a lot of signals that this was not going to last. And so the way to make a play on this, say if you were just looking at this right here, so you see this bearish trend in the RSI, you see it trying to push up above, and this is known as a bearish divergence. So higher highs on the price but lower highs on the RSI. Very bearish signal again, with all of these EMAs pushing down up on it. And so that was the highest up it could possibly get with all of this downward pressure. So what I would do, not financial advice obviously, I would place my short right below all of the EMAs. So specifically, say if you were only right here, this is all you were seeing, none of this had happened yet on the right, I would place my short probably maybe below this point of potential support right here, maybe at, I don't know, 420 or so. And we obviously see what happens here. So that is the way that I like to use these Fibonacci numbers in conjunction with EMAs, which I'm already familiar with, but it's just because all of the numbers have this obvious correlation, and I think it's better than using kind of arbitrary numbers in conjunction with EMAs, because you'll see how many times that these lines get respected very accurately. So it was such a slight push-up or dip above the EMAs, or this longer term one, and you know, it'll just touch on these lines very, very often. So you know, the more you get used to them, you know, the more it'll appear, I guess, helpful to you. But again, here's like you'll just see very few times where it spikes out of the range of these moving averages, and that is when it's just diverged too much from the average trend. So one thing to preface: you always want to make your plays in conjunction with the macro trend. So what has this been doing in the long term? So you wouldn't want to place a bet on this price going down in this kind of trend, even if, you know, you could make some kind of play like right here, but even if you were successful, it wouldn't be nearly as profitable as if you were playing with the trend, because then you could place a short, you know, I mean a long, actually. You could place a long, say probably right here, and you play it all the way up from, you know, 4 to 8, 900. If you saw that all of these EMAs are pushing, providing support, and it dipped below, I would place my long back in this range of moving averages once it gets back up with the trend. So if this were a full rejection, you would see it bounce up, test these long-term EMAs at the bottom, and get rejected for another lower low. And we see obviously that did not happen. So that is how I like to utilize these. Of course, there are many other ways. There's actually a way to plot the Fibonacci kind of ranges that are more stagnant, not moving averages that are constantly updated, because every new candle changes, you know, these numbers. So I actually prefer that, because I think I want to encompass all of the information, not just a specific data set. But I can cover that in another video. I just wanted to give a short kind of synopsis on how to use this, or how I like to use it. So yeah, so that's pretty much all I wanted to cover. Thanks for watching, and I'll see you in the next one.